Chapter 9, No Tax Equals More Growth. The Roth IRA has no RMDs, which means it can grow for as long as you and your spouse live. You cannot get the same growth potential in a traditional IRA where you are mandated to take distributions each year. Think about it like this. You and your spouse are both 68 years old. What is better to have, a $100,000 tax-deferred account or a $75,000 tax-free account? The answer is the tax-free account. Seems counterintuitive, doesn't it? $75,000 is significantly less money than $100,000 after all. But the entirety of that $75,000 account is yours, and you will never have to touch it unless you want to. That $100,000 account, though, has a huge lien on it called the IRS. Slowly at first, but in a few short years, RMDs will increase until the account is nearly depleted. Now, one could argue that you could take the RMDs from that tax-deferred account and invest them in a side account, but you still pay tax on the RMDs as ordinary income to begin with. And then secondly, if your side account has its own distributions, you could pay tax there as well. Even if you're in the 10 or 12% tax brackets and don't pay tax on capital gains or qualified dividends, you still pay ordinary income tax on interest. And that interest can also move you into a higher tax bracket, potentially causing your dividends and capital gains to be taxed as well. Because there are no RMD requirements, the Roth can pass from one spouse to another without ever having to be touched. And we're talking decades of potential tax-free growth here. When non-spouses do inherit the IRA, they do have to take required distributions, but even those RMDs are tax-free. The Roth simply can't be topped when it comes to generational tax-free wealth.